growth is concerned. So I think there's a lot of conducive environment for overall equities. And the other very interesting thing is that we've seen inflation cooling off, right, across most of the commodities, right? And that also is indicating that somewhere the interest rates have kind of peaked out. Okay, we may keep on debating that are they going to start sliding down maybe 1 quarter or 2 quarters down the line, but the fact is that they have definitely peaked out, and it's just a question of maybe 2 quarters or 3 quarters, and we will see at least 100 200 bips kind of cool off as far as the interest rates is also concerned. So I think a lot of this things are coming into play, a lot of factors which is allowing the buoyancy in the equities as an asset class.
Right. No, you did talk about the political continuity, and staying with that theme, with NDA 3.0 leading the charge this time around, do you see a populist budget? What could be the major highlights this time around?
Yeah, Kshitij, so that's definitely a tricky one, and the fact is that if you think about it today, there are already 2 or 3 states. If we have to take a cue from there, there are 2 or 3 states, including Maharashtra, where we've seen some measures of populism, right? Somewhere, whether you call it the women giving 1,500 rupees, or I mean across a couple of other states also, something or the other has happened, right? And
yes,
these are again, I would say NDA states, right? So there might be some bit of populism in the budget also, and that's where I come across as far as the tricky part is concerned. Because on one side, if you till last year we managed the fiscal deficit very well, as you know. This time, if we are going to have some loose strings as far as the populism is concerned, I think also the challenge is that I think your tax collections may not be very surprising from what they've been already built in now, because we've had a couple of years of good surprises as far as tax collections are concerned. But I think now the base has got formed, and whatever numbers they're building in, maybe that's the best case that one can assume. So the key thing is that if you're going to have some expenditure, or some revenue expenditure, or some populist kind of measures which will relate to revenue expenditure, the revenue. The tax collections may not be very different than what you are budgeting in. Then can the fiscal deficit be a bit higher, or will the capital expenditure take a backseat? So that's the tricky one. I think is something what we would like to look out for as far as the budget is concerned.
Well, the government this time around has to walk the tightrope this time. That's what probably all the indications point out to. We'll talk about taxation and fiscal deficit, late in the show, definitely, and we'll touch upon these topics in details. But in the meantime, Sachin, let me also get your quick view on will this budget sort of lay down the foundation of Viksit Bharat by 2047? Because this is one thing which has been stressed upon multiple times, be it in you could say in the interim budget and the other following events as well. So, what are your views? Because that is clearly the vision of the Prime Minister.
No, clearly, I think that is something what they are extremely focused about. Okay, and I think they're working towards it. One of the common threads across the last almost 9-10 years of budget is that there's a lot of continuity, right, across so many policies, right, across so many schemes that they announce, right? And budget is just a 1-year event where we talk about what has been the revenue and the expenditure and the breakup of that. But I think the key thing is today, for any kind of investor, whether it is your foreign investor, whether it is your domestic investor, whether it is your corporates, whether it is your industrialists, I think one very critical thing that all of them look forward to is the continuity in terms of the policies. Because when you're going to invest millions and billions of dollars, I think these are not 1-year plans. These are at least 5, 7, 10-year plans, right? So say, for example, PLI schemes, right? These are very long-term plans, and the corporates have actually reciprocated to that scheme brilliantly. So I think the continuity is something what is a common thread from the government side for last so many years, if I can say so. And I think that gives a lot of confidence that the vision that they have for the next 10, 15, 20 years is the focus for sure.
Absolutely. And in fact, in the interim budget, Sachin, government did announce an outlay of 11.1 lakh crore, and the number did get a bit of its own, you could say the limelight around about that time, what 11.1 lakh crore means, in different ways. So what is the big ticket spending that will happen in the final budget? We've already seen some big moves in railway stocks in the run-up to the main event.
Sorry, Kshitij, the last line I couldn't hear you.
No, no, I was just saying that we have seen a little bit of move in the railway stocks in the run up to the main event. So for the infra or the big ticket spending space, what are you seeing this time around?
So Kshitij, again, if you take the last 5 years, year after year,
Mhm.
the capital expenditure, whether it is railways, whether it is roads, whether it is water, whether it is irrigation, whether it is affordable housing, all of that has been increasing year after year, including defense, right, across the
Yes.
board.
Yes.
So I think that focus remains. And of course, railway needs a tremendous amount of capital expenditure, and the government has been providing for it year after year, I think. So I think today, even when we talk to so many vendors to the railway board, I mean vendors to the
Mhm.
railways, they all are extremely upbeat in terms of their order books. They are extremely upbeat in terms of
Okay.
the way railways is releasing new orders. They are
Mhm.
extremely upbeat about the new plans that the railway has for the next 3, 5, 7 years. So everybody is in the capacity expansion mode at their end, because
Mhm.
they are the people who are at the ground. They are the people who are dealing with railways day in and day out. They don't just do their capacity expansions or planning on the budget announcements. They are the guys who are actually getting their hardcore order book. They're getting their infrastructure in place, which is where
Mhm.
I think the proof of the pudding is. So clearly the
Yeah.
focus is there of railways. I mean, I think entire infrastructure, whether it is railways, ports, airports,
Mhm.
across the board, including defense, we have seen tremendous amount of focus. And we really hope that this continuity is there even for the next 5 years, at least next 5 years.
Ah, right. And we did talk about a little bit on fiscal deficit. So, what is the fiscal deficit target you foresee for FY25? Is there a number that you think could halt or sort of put brakes on the bull run? Why we sort of say that is because we did touch upon the populist measures coming in this time around. And if you think that there could be a number higher, and there will not be any surprises from the taxation front. Any number you foresee that could probably halt the or at least give a knee-jerk reaction?
Yeah, I think probably anything more than 6% will probably be taken a bit negative. But as
Mm.
long as it is sub 6%, I think it should be okay. That's one part of
Ah,
it. But as I said,
right.
Kshitij, the more important thing is the detail. The devil is in the details, right? How are you going to
Ah,
manage your fiscal deficit? Is it at the cost of
right.
capital expenditure? Is it at the cost of
Mm.
higher? Are you going to burden the taxation on some certain class of the people? I mean, how are you going to manage
Right.
it? Also, is a very critical thing, right? Because I think that's more important as far as the foundation is concerned. I mean, you may be able to manage. I mean, see, we have to also understand one very important thing, that government still has a very large window as far as the disinvestment proceeds are concerned. They haven't yet utilized that window for last so many years. I mean, in a big way.
Mm.
Today the markets are
Mm.
very conducive, particularly the kind of the re-rating that we've seen in so many public sector units across the
Mm. Mm.
industries. So I think that is one very large window, or the one large room that probably the government has to manage the fiscal deficit without compromising on capital expenditure, and also might have
Mm.
some room as far as some bit of populist measures.
Right. And in fact, now the pricing for most of the PSUs have also gone up in terms of the stock price. So they'll get a better valuation and a better proceed from
Yeah,
the divestment. Right. Now,
exactly. That's
you
what I was
did
saying. There's
touch
a
upon
tremendous
the,
amount of
yeah,
re-rating.
right. And in fact, you did touch upon the taxation front. Do you see any tweaks in the taxation structure, direct or corporate tax?
Kshitij, one of the, again taking that common thread of continuity, right? So I think very
Sure.
important aspect over there is again, because a lot of investments are planned by even investors. I mean, whether it's a passive
Mm,
investment,
mm,
whether it's a direct investment, doesn't matter. But when people actually do their planning of investments, they take into consideration all aspects, and taxation is an important aspect that they always consider.
it's
So I
fun.
think
Yeah. Mm,
if I'm investing in a particular asset class, like say for example today, government has a scheme called sovereign gold bonds, right? So there they have
mm,
given
mm.
a capital gain exemption for investors who hold it for 8 years. So any investors who investing in that sovereign gold bond is planning that I want to own this stock, I mean own this bonds for at least 8 years and take that taxation advantage, right? Similarly, today every asset class has certain kind of taxation policies, whether it's your equities, whether
Mm.
it's debt. I mean, all of that, right? So I think also, we have seen that whenever you have not taken to the extremes as far as taxation is concerned, and you've kept it very balanced,
Mm.
and you have actually reduced some bit and encourage consumption, that has a multiplier effect in the economy. So, hoping that there will not be any very drastic or significant
Mm.
changes as far as the direct taxation is concerned. I think on the indirect taxation, clearly it is now the prerogative of the GST committee. So I think
GST
that is
committee. Yeah.
where again there might be some room, because I think the GST
Mm.
collections have also now gone through the roof. What used to be
Mm.
sub 1
Mm.
lakh has now decisively gone beyond 1.5, 1.6, 1.7 lakh crores on a monthly
Yes.
basis.
Yes.
So I think there might be
Yeah.
some room there also, if one has to boost consumption, because we've seen some slowdown in, I mean, for a significant period now, as far as rural area is concerned, we've seen some slowdown in consumption out there. And even in
Mm.
urban side, we are seeing some early signs. So I think before it gets into that vicious cycle, I think government probably can
Mm.
take some steps as far as to boost the consumption is concerned. And again, they have a levers both on the indirect, which is the GST, and also some bit on the direct taxation, because both of them, whenever you lower a little bit, we've seen historically across countries that it drives consumption, and which again
Yeah.
has a multiplier benefit to the entire economy.
Right. And in fact, Sachin, the voice is sort of growing louder about the premium valuation in the small and mid cap space, but the rally is going stronger by the day. How should investors sort of play this space in the rest of the financial year, FY25? Because I think what could be one of the reasons is the PLI incentive that could actually go on, and the Atmanirbhar Bharat initiative that is taken by the government. That is something which is pushing the space higher. What are your views on that?
Yeah, so as far as mid cap and small cap is concerned, I think you have a very valid point. Clearly, within the mid cap and small cap, there is a certain segment which has a lot of froth. There is no doubt about it.
Mm.
The stock prices are probably discounting in the next maybe 3, 4, 5 years of earnings. So in that
Mm.
sense, probably stock prices are running a little bit ahead of time, and that is where there can always be some bit of volatility coming in. So I
Mm.
think for the portfolios that personally that I manage as far as our flagship product, which is Capital Builder, is concerned, uh, we
Mhm.
have clearly moved more towards large caps. What used to be probably
Ah.
55-60% large caps in our portfolio, today it's 70% into large caps, right?
Okay.
We still have about 30 odd percent in mid and small, but what used to be 40-45% has come down to probably 30. And
Ah.
bottoms up, there will always be good businesses which you would like to own, and I'm sure that's the case across the markets. But I think
Mm.
we have to also be cognizant of the fact that there will be some bit of volatility today, there is tremendous amount of liquidity into the mid and the small cap mutual funds, and that's also
True.
probably one of the driving forces for the mid cap small cap stocks remaining so buoyant. So it's not only purely fundamentals; it's to do with
Yeah.
some bit of liquidity, and
Liquidity as
that's
well.
the
Yeah.
that can lead to some volatility as and when the liquidity decides to probably take turn or tries to move into some other large caps or some other asset class, depending on the mood of the investors at that point in time. So I think that's the only risk that we see. I think other than that, there are a lot of good businesses. The I mean, a lot of entrepreneurs who are in that mid cap and the small cap space. I think
Mm.
they are seeing tremendous amount of opportunity in their businesses, and they are extremely motivated and very encouraged to capitalize on some of these opportunities over the next 2 3 years. So I think it's a very bottoms up thing, rather than a very top down, just saying that mid cap P and a small cap P is too high at an index level and just deciding. I think that will be a bit
Mm.
unfair to paint the entire mid cap and the small cap segment with just one brush, the entire P of the index.
Mm.
It's a
Mm.
very bottoms
Mm.
up thing, but it's definitely a time to be a little cautious. And
Mm.
relative valuations probably today in large caps are a little more reasonable compared to mid and small, for sure.
Mid and small cap. Right. And now there's a lot of chatter on the consumption getting a big boost in the budget. Are you also seeing some probably recommendations coming in, or some sort of verdict coming in the budget?
Well, again, that's going to be part of whether you call it populist, whether you call it by way of
Oh
some
yes, right.
taxation discounts, some taxation concessions. So it's again, as we discussed, it's going to be a thin line, or it's going to be a
Mm.
very fine balance that the honorable finance minister will have to walk through. Fingers crossed.
Yes.
Let's hope for the best.
All right. Well, in the meantime, I think we've got one question from one of our viewers, and Amit wants to understand, what is your outlook on the pharma space for the next 5 to 7 years? He looks like to be a long-term investor.
Right. Sure, Amit. Amit, thank you for that question. Frankly, we as at a portfolio level in our flagship product, which is MK Capital Builder Fund, we are fairly overweight on the pharma sector. But pharma, if I can divide it into three or four segments again there, three or four sub segments. So one is clearly the domestic formulations business. Then second, you can call it as the US generics business. The third is the US specialty products business, and the fourth is the CRAMS, which is the contract research and manufacturing and the CDMO space, right? So these are four, I would say, big sub segments. If we have to just go, because again, pharma is a very bottoms up. Every company will have its own strengths. Every company has its own character as far as in which of this four segments they're present. Some of them are present in two of the four, three of the four. Some of them are only in one of them. So you'll have to play
Mm.
accordingly. But among the sub segments, I will probably share my thoughts, which ones we believe would do well. So the domestic formulation segment, I think, is one of the most, I would say, profitable businesses. It has upwards margins of upwards of anywhere in the range of 25 to 35%, depending on the size of the company and depending on the within the therapeutic segment that they're focusing on. So that's one of the very profitable segment, and a growing profitable segment, because it continues to grow in the range of anywhere between 7 to 10% on an annualized basis. So I think companies which are focused in that segment, companies which have some decent scale, companies which have some decent brands and who are leaders in the therapeutic segment they are. I mean, if they are one of the top three players
Mm.
in the therapeutic segments that they are catering to, I think that is one definitely segment we are very positive about. Then it comes to say US specialty. Again, there are very few companies today from India in the US specialty, but companies which have cracked into that segment, I think, are doing wonders, and they have a very long road. And I think they have not even scratched the surface now. But whatever they have achieved is very encouraging. So I think US specialty business is a very tough business from a competitive landscape, because you're actually, your competition is the Goliaths, the Abbotts and the Pfizers and the Glaxos, and I'm talking about the global not the Indian counterparts, but the global parents are your your competition in those US, in the
mm,
developed markets, the US and the Europe and the Japan. But if you are able to
right.
crack those markets, I think it's one of the most lucrative markets. So that's the second. I think third is, which is the US generics. I think clearly over the last now almost 6, 7, 8 years, we have seen that market
Mm,
is having a lot of tough time. Thanks to there's a tremendous amount of consolidation at the buyer end, because if you have only three players, at least in the US market, which is the largest US generics, largest generics market, only three players
mm, mm,
commanding 95, 97% of your entire market. There's a tremendous amount of
right.
consolidation, and it's going to be difficult for manufacturers to earn supernormal returns. Of course, there will
Mm,
always be shortage in certain products, and over there you can make things, but it's a very, very cyclical thing rather than a very secular thing out there. So I would say that is one area which is a little tough one. And of course, the
mm,
fourth, which is where we are extremely positive about. We believe that's the next 5 years, 7 year, 10 year trend. Although the last 10 years have also been very good for the CRAMS
mm,
and the CDMO players, the contract research and manufacturing players, and even the custom synthesis players. I think it
mm,
also not only pharma, there are also a lot of specialty chemicals, which is a part of this segment, I would say. So I think
mm,
that is the most lucrative segment. These are players who cater to only global customers. They have, I would say, established their right to win in the global markets. They have the domain
mm,
expertise. They have demonstrated that they can deliver the scale to the global requirements, and they also respect the intellectual property rights, which is also very sensitive as far as their global customers are concerned. So I think that is one space where we are extremely upbeat about, because we believe that's a 5, 7, 10 year secular trend, and there's a tremendous amount of business tailwind, whether it's Europe plus one, whether it is China plus one. All of that is coming into play.
right. Well, I hope, Amit, you got your answer there. And moving on to my next question, Sachin, very quickly, do you have or do you foresee any measures coming for the auto ancillary sector? Because that is also something which has picked up quite well in the last few years or so.
Yeah, so Kshitij, again, there is a very good PLI scheme for the auto and auto ancillary segment, and there has been
Mhm.
a tremendous response again for that scheme from the industry side to the government. I think PLI is probably one of the schemes where I've seen the maximum response from the industry side, and auto
Okay.
ancillaries are also very well capitalized on that at this point in time. So
Mm,
I think other very important thing is that on the auto ancillary side, exports is a very large opportunity. Again, there
mm,
these are companies in that sector have established that they have the domain expertise. They can deliver
mm,
the scale and the size for the global customers, and so they have established the right to win. And even we have seen so many companies now who have already got
mm.
their tie-ups for the components on the EV side, right? I think
Yeah.
that's again a very encouraging thing.
Mm,
So I think any kind of support to even further boost the exports is
yeah.
something what I think can be very helpful, not only for the sector but even for us as a country,
Mm.
because this is one sector where we can hope to earn tremendous amount of dollars from the manufacturing sector.
Right. And very quickly,
Like that, about 8 or 10 or 15 of them
mm,
actually got that there.
mm,
So I think one round of that consolidation is already done, and that was probably a relatively easy thing. But I think
okay.
from public to private, I think there are so many considerations. Whether it comes to your employees, unions, customers.
Uh,
I mean, there are so many
mm,
stakeholders that one will have to consider. So you will need a very it's a long run process with a lot of
long
policies
term.
which will precede before any of these things actually play out. That's my limited sense.
Right. And staying with the PSU theme, in fact, we've just got another question from Varun. So he wants to understand what are your views on the PSUs for the PSU banks for the medium to long term. Is there more room left in terms of growth and returns? Because I think in the last few months, we've seen quite a bit of rally in the PSU banking space as well.
Right. We have to understand one thing that the PSU banks had a tremendous amount of outperformance over the last, I would say, maybe 12 to 24 months. One of the reasons is probably their valuations were significantly depressed, right? They were all trading at probably price to book point 0.3, point 0.2, point 0.4, that kind of thing. So the valuations were significantly depressed. And of course, that kind of has caught up now. There has been decent amount of re-rating as far as the valuations are concerned. So I think the valuation arbitrage game that was available is probably not so much there compared between the private and the PSU banks at this point in time. So from here on, the key is that will the PSU banks actually deliver earnings growth? Will they deliver their asset book growth? Will they deliver a deposit growth? Will they? I'm sure the asset qualities are fairly well under control. The books have got very much cleaned up over the last so many years now, and hopefully that will not come back. But irrespective of the asset quality, important thing from here on is going to be: will they have a good quality loan book growth? Will they have a,
Right.
good quality deposit growth? Will they have a good
Mm.
profit growth? If that all plays out, yes, there might be some more re-rating within the PSUs. So I think it's going to be very selective within the PSUs rather than the entire basket, which has done so well in the last 18 months.
Right. Valid point there, Sachin. Well, on that note, thank you so much for your time. And that's all for now. But do stay log on to ET Markets live stream for more on investment, business, and economy. Thank you so much for your time, Sachin.